Okay, so we'll get this show on the road. I'm Tim Quast with Market Structure Edge. It is January 30 already, just like that. Boom, a month gone, and Groundhog Day looms. Along with me today, as usual, is Brian Wilson, market strategist, and we will divide and conquer. I think I went first. Brian went first last time, so I have to go first this time. We try to trade off anyway. So I've got several things to cover, and hopefully they'll be helpful. uh, I will say for this is sort of an editorial note. Those of you who are Edge subscribers, and not everybody on these demos, because anybody could come to these, is an Edge subscriber. I presumably many of you are Interactive Brokers customers, and I noted in a market desk note, I think on Monday, we're in, I would simply say negotiations. Yeah, I will not be pejorative about Interactive Brokers. We've been there for quite a while, and I like those folks a lot. They're very good at getting you to give them stuff for free. Right there. and they and they make money hand over fist. If you go look at their financials, it's just unbelievable. Their margins, they have 75% close to it operating margins. I mean, that is a very, very profitable business, and it's a big business. 82 billion a market cap. That is a big organization, and we're very small. We've been very successful with them. But I fiercely defend our IP. So I said I would give a quick update on this. I'm not going to belabor it. But we have stopped providing our daily trading ideas for free through the platform. And it's just, it's a negotiating tactic. And you guys can really help us if you would. The best thing that you could do to help us, if you're so inclined, is if you're an Interactive Brokers customer, go to your account, go to the message center. I do this all the time because I'm asking them questions and I'm saying, how come you charged me this, or how come that trade didn't execute, or whatever. And it happens, right? Stuff like that happens. And submit a ticket saying, please bring daily trading ideas from MicroStructure Edge back. And if you do that, if they get enough of those, it helps us at the negotiating table. That's what it is. So, we've driven a lot of revenue for them because we've got an active group. I appreciate your forbearance. I hate to drag you into our dirty laundry, but this is business. That's how it goes. So, anyway, now to the more important matters here. I'm going to share my screen, and we will get into the nuts and bolts here. The top item on my list is, could you have avoided what happened to NVIDIA? I mean, there were a bunch of others, but I pick on NVIDIA because it was down 17%. How do you avoid a risk like that? And this won't work perfectly, but it's a very good thing to always check. And you'll note that, whether I'm writing the market desk notes or Brian is or Henry is, we always return to the same three things over and over. We say broad market sentiment, understand the big picture. You always have to be aware of the big picture. Number two, know the context. What is occurring around us that can affect outcomes? And then we trade divergences or convergences. Divergences long, convergences short. That's it. We repeat that over and over. And there are three things that determine the outcome in the market. And it's not, business performance, believe it or not. It is demand, supply, and volatility. That's the holy trinity right there. And if you know those things, you have a huge advantage, and it's very predictive. So here's how you could have avoided, and it's when you don't hold something over a weekend. If there is rising demand, that's not even a good spot to check. Let's come back here. Rising demand, falling supply. I'll hold something right over the weekend. I know that the data are on my side, right? The risk doesn't mean it will be perfect, but most of the time, call it 90% of the time, round figure, you are going to be fine if you're trading, say, momentum, daily trading ideas, momentum stocks, and you took a position late in the day on a Friday, let's say, and you think, okay, now I'm going to hold this over the weekend because I expect to benefit from the divergence on Monday. And I would do that, 9 out of 10 times under these conditions, when it gets to the red line, not going to do it. That's the problem here. On January 24th, supply was rising and demand was over the red line. Right? So now we have risk. And it's not, that's when you don't hold a position over the weekend. That's how you use the big picture to help you. Always check that. And you say, well, what difference does that red line make? Well, you could go run this as far back as you want and look at what happens when it's over the red line. It's not perfect. Sometimes it comes before. This was election related, so there was some distortion. Sometimes it comes after, but the market tops there. And sudden things can happen. I don't, do I know if it was DeepSeek or something else? The DeepSeek is an easy excuse for something that was bound to happen. In the data, to me, I've been talking about this, that three big things have occurred that occur when bear markets are about to develop. And again, I don't know what's going to happen, but those things have all occurred. And in the past, that we've had corrections and or bear markets when those things occur. And if I can remember the three, I'll tell you. I write about them all the time. It's just not, they're not right in front of me. But here are the problem. Why did we suddenly drop violently? Well, in large part, remember, the broad sentiment topped at 5. It was at 5 or 6 or 7 days. That's a top. And yet the market rose when we hit derivatives. And then demand started rising again. So we had this it's a very unusual, we could call it a pattern. I think of these as signals more than, they're not metronomes, but they tell us about the demand supply balance. Very unusual. So this means that there were bloated derivatives bets. Probably people got forced to cover stuff. And there tends to be a shoe that drops after that. Somewhere it's going to show up. And by no means do I think we're through that, by the way. And so then it shows up on Monday the 27th, and everybody casts around the Shazam, what happened? Oh, it's DeepSeek. That's what did it. Wipes out all this value, and other stuff goes up. Interestingly, on that day, there was net buying. If you look at we like to look at how things behave relative to midpoint. It's very interesting to look at. And it strips out your distortion created by price. Remember, one of the things I don't mention it all the time. Don't trade price. Trade demand and supply. Price is capricious. Price is set by Citadel, who's trying to fleece you. So don't be fooled by prices. They don't look very far ahead. They look fractions of seconds ahead. We're looking 1 to 5 days. Or if it's long-term portfolio management, we're looking at the ebb and flow of demand and supply. That's what we're looking at. I'm not going to put more money I've got long-term money to deploy. And what am I going to do with that? Well, I'm not going to certainly not going to put it into the S&P 500 when it's at 7.2. Not going to do that. It's not a good idea. Far better to put it in when it's at 3, which we don't get very often. This is one of the things that happens in bear markets. You could go back to November of 2021. We had a screaming pandemic bull market. And suddenly, I believe it was the day after Thanksgiving, suddenly the market dropped sharply. And you could go look at what the demand supply balance was then. And it was the beginning. We had a really violent volatility event in December. And then in February, Meta lost 250 billion of market cap and we crumbled into a bear market. All those things have happened again. Now, I'm not saying that they will produce a bear market, but I'm saying these are not great conditions. Look at what supply has done. Boom, 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 boom. It's just a relentless rise. Now, it's not back to 50%, but this is a complete change of regime. The last time this happened was the other direction at October 31st, 2023, when the Fed stopped hiking rates. Remember, it's the end of a regime. Now they've paused, and this happened before that, by the way. So I don't know that that's going to be bad for the market, but it certainly could be. A relentlessly rising supply side in the market is not good. It tends to undermine performance. So bringing this all the way back around, when you're over the red line, be very careful about holding positions over a weekend. It's telling us it's getting more difficult. Look, we've had plenty of opportunity to trade momentum, and the momentum portfolio has been fairly accurate in telling us that. But I would look at this now and say, be very careful. For the mechanics, I would be much more inclined right now to look at low volatility. You say, well, why would you ever trade low volatility? I don't want to make 1%. 1% is pretty good. Right? If you can make 1% all the time, every time you trade, you will be rich. You don't have to make 100%. And you won't, but you don't want to lose 17% either. That's, it's very important to avoid risk and take small gains as a general rule. Right now, I have I rarely would do this. I have my own Big Short, The Big Short. And if you've read the book or seen the movie, that comes with a lot of risk. And, the poor Michael Burry thought he was going to lose everything. Right? And finally, it paid off. I'm not recommending that you do this. This is what I do. Not very often. I like to take gains, not chances. But I think that this is because of all the data, and I could be wrong. Been wrong. I'm wrong routinely. The data to me tell me that could pay off. Now, if it doesn't, then I will have chosen poorly. Most of the time, taking 1 or 2% is vastly superior. I mean, if you just went to Bank of America, they've already reported results. We don't have that shoe that could step on us in that stock. You look at this, is it perfect? I don't love the return on the supply side back up and down. It's one day down. That's why it's in the group, or why it's in this data set. But you look at that and say, if the market has a hiccup, you're going to make your 1% on that, because that's how the market works. Now, the number 4 characteristic of large cap stocks is volatility hedging. Believe it or not, when I say characteristic, what I'm talking about, it looks like I have 1 minute left, don't I, Brian? I've covered basically what I want to cover. There's one more little thing now I forgot what I was going to say. But coming back to this, the principle here is that when I remember now, characteristics. So when I refer to characteristics, I'm talking about the things BlackRock buys, not what a stock picker buys. Fundamental Benjamin Graham bottom-up investment style, where you're trying to find great companies at a reasonable price, as Warren Buffett likes to say. That kind of investment is 10% of market volume. 90% of it is something else. BlackRock, Vanguard, State Street, Geode Capital, I could go on and on. There's one stock picker left in the top 25 holders of U.S. equities by 13F filings. Now, many of them are blended. They may have active portfolios and passive portfolios, but most of that is asset allocation. Very same thing all of us are doing in our retirement accounts. Target date, balanced, low volatility, risk hedged, diversified. That's what we're all doing that, right? So in the market cap is far and away the largest characteristic. And then it's value and growth. So you could go large cap value, large cap growth, large cap blend, all cap. That's the stuff BlackRock buys. Believe it or not, number 4 is volatility hedging, because there is so much effort to try to mitigate risk of volatility because the market's very volatile. So what happened when NVIDIA went down 17%? Stuff like American Waterworks, Campbell's Soup, ConAgra, they went up 2 or 3% or more, right? How does that happen? It's because of all the volatility hedging in the market. So when you know that the market is topped and supply is rising and there could be a bump, what happens tomorrow? Context, anyone? Month-end options expirations. Go back and look through history. Has been a very bad day on many occasions. I'm not predicting that it will be. I'm just saying we know there's context and we understand what's occurring. And that then things like this could give you your 1%. So everybody else is experiencing losses and you're taking 1%. If you do that over and over, you're going to be very successful. And that's the way to do it. I mean, go look right now. BAC is probably in the entry range. Last time I looked, it was around 46.9. It's there. You don't have to be perfect. And again, all you're after is 1%. So it doesn't take much. 47 cents is 1%. That's all you take, right? So at 47, you're out. There's your 1%. And you do that over and over. Boy, there's no stress in it. Doesn't always work. You have to recognize there's risk. You got to make sure that your stops are well below BAC's volatility, and that's in the portfolio view. Brian, I'll hand it off to you in just a moment. You can just hit low volatility again and go back and look 1.6%. So you still have to have a stop down 2%. There's always a chance that you get stopped out, but BAC doesn't move very much. And in a bad market, you get the bounce. Those things are that there are the mechanics. It is that simple. And that's how I think about it. We'll probably tag team what's ahead, but I'm going to stop sharing there and hand off to you, Brian.
Sure. No, thank you. One question for you, Tim, before I pick up the mantle here. With sentiment probably topping here, maybe tomorrow, maybe today, maybe tomorrow,
Yep.
Would you kind of shift your attention more towards the low volatility portfolio when sentiment starts moving lower?
I would. There's no correlation really. I mean, it's not that that the momentum portfolio is more or less likely to give you results when the market is topped. I mean, momentum is a product of things being topped, hitting 10, right? That's what does it. It really is a core feature. So they may be fine, but the number has been very volatile. There were a few days ago, there were 44 in the daily trading ideas, I think 47 in the momentum portfolio on the Edge dashboard. And now there are 14 or something like that. I mean, it's wildly volatile, right? That's the fact that those numbers are volatile tells you it's riskier. So again, it depends on your own constitution. If you have the constitution where you don't mind 2, 3, 4% risk, and again, the market moves 2.5%. Momentum stocks move at least 3%. So you have to have a stomach for a little bit of risk to produce your 3% return. Remember, if something goes down 3%, it's only an implied loss, right? It's only realized if you sell, right? That's the problem. And then if it goes, like stocks that are in this portfolio, they move like that all the time. The whole S&P 500 moves 2.5% all the time. It's crazy how prices move, right? It's like a seismograph. So you just have to go in knowing that. And if that does not appeal to you, trade low volatility. It's the easy approach. Take little gains. Little gains over and over and over is exactly how Citadel. Well, let's even take Jane Street. Jane Street made $11 billion last year, taking a tenth of a penny. There's a lot of money in small gains.
Perfect. Thank you. I appreciate that.
Yep.
Go ahead. I'll go ahead and share my screen, pick up a couple of talking points here. I think I'll start with an NVIDIA example. And I just want to share with you what was happening before we got this sell-off. And I think Tim mentioned this in a recent market desk note, but just to kind of talk through what you can actually see in the data over time. So I'm taking NVIDIA. I took it back a year here. And what I want to show you is what started to happen to demand. So for NVIDIA, obviously, for a time here, it was the number one stock in the S&P 500. It was obviously on a roll for the longest time. And you can see as a normal part of the market rhythm, it'll hit 10, it'll go back down, it'll hit 10, it'll go back down. It's just a normal part of the cycles of the market. Now, notice what started to happen as we moved towards November. As we got to November, we're no longer spending any significant time at 10. It just briefly gets there, moves back down. What happens after that? We never hit 10 again. So you can clearly see that demand was starting to come out of NVIDIA even before, this week's rough patch. So, just a quick and easy way. And it was a good lesson for me this last week. When I'm looking at names, I'm starting to take them back a year now, and just to get a feel for the rhythm of that name. So in other words, hey, if it hits 10, what should I expect in this name? What does it normally do, in that type of scenario? Let me give you an example here. This is actually one of my clients on the IR side of the business.
Hey, one quick interjection too. Just to add a little context in there. It's interesting. You go back and look at those periods where NVIDIA spent a lot of time. Some say tomato, some say tomato, some say NVIDIA, some say NVIDIA. Anyway, what I was going to point out with NVIDIA is that those two periods where it was at 10, the only the dips each time options expirations. It's where they were,
Mm,
right? It's the only those little divots in the very strong demand, and that tells you people probably, cashed out of their derivatives positions. And I'm talking about like around February 21, 24. And then again
hmm
in that
hmm
May timeframe, that was May options
Yep.
expirations. So those little divots occurred
Gotcha.
at options expirations. Just to, again,
Yep.
context matters. Very important. Sorry, Brian.
Yep. No, that's terrific. That was a great addition. Yeah, I just wanted to share with you, and I have just a number of names on my watch page every day. I'm sure you do as well. And I was noticing yesterday that Dell was finally exhibiting a little bit of strength. And I'm like, okay, well, it's exhibiting a little bit of strength in a down market. And I took it back a year, and you can see that sentiment starting to rise from a one. Shorts actually getting covered in Dell. So I took it back and I'm like, okay, so what normally happens when sentiment it starts to rise for Dell? I'm like, okay, well, post gains, it post gains, it post gains, it post gains. And I think there was like maybe one time during that whole stretch where it didn't. I'm like, okay, well, if it normally post gains when sentiment starts to rise and I have a low short volume environment, I'm going to buy that. It not necessarily on the daily names or what have you, but it was just on my watch page. And the point here, you can check this type of data for any name, whatever you might track over time. And this is something that came to me this week. Just take it back a year and look at the normal rhythm. Look at how this thing trades. Has anything changed during the last 3 months? Where that trade might no longer work. Those are certainly considerations you want to take into play. I mentioned this morning the healthcare sector, and hopefully the note was self-explanatory, but I'll kind of walk you through what I was looking at. And I'm seeing this more and more over time, and money will move back and forth between sectors. It just does. Some sectors obviously have much more of an impact on the market than others. Tech sector at 31% is going to have much more of an impact than real estate at 2%. It just goes to point. And
in this investigation.
Tim, do you mind
We are
checking to
going to
see if
conduct a
we can figure out where that noise is?
investigation of this entire tragedy, looking at the facts. Now, with that, I want to level set.
So looking at healthcare, it was what I mentioned this morning. We can see that demand started to rise. Look at this incredible short covering. And obviously it's difficult to find the exact period in time, or short started to cover here. It would be hard to enter that trade at that particular point. But even if you got to it around here, there was a lot of upside from a sector perspective in that particular trade. I'll share my screen here in just a second. I've got both the healthcare sector and technology up on my screen. Both of them look very similar. I also mentioned tech this morning. Look at the short covering that's been occurring in tech over the last couple of weeks, and let me show you what I'm talking about here. So you're looking at the spiders. In blue is the healthcare spider. In yellow is the tech spider. And you can see, very clearly over a 1 month time frame. If you picked up that sector trade a little bit later, there was still a lot of upside in that trade. And tech did just what the data would tell you that it was going to do, obviously up until yesterday, or excuse me, Monday, when it took a big divot, and we're working through some earnings related things right now. But very predictive. If you recall a couple of weeks ago when the big financials started to report, and I think it's still, we can still see it here. It was very predictive there as well. Look at the short covering in the big financials right ahead of reporting season. Very different now. Those short volumes have zoomed back higher, and that whole sector is getting very, very toppy sentiment near 10 for most of those. Let me share with you just a quick update on, let's call it the short portfolio. And my friend Barry, I keep his portfolio up, and this is another one that I keep up. The difference between them, and I'll share my screen for a moment, and you can see if anyone's interested here, if you want to perhaps take a screenshot. This is the criteria for Barry's portfolio. The point here, it's kind of like the momentum portfolio in reverse with market sentiment. Think of it as your companies that are hitting tens and they're starting to come back down again. So market structure sentiment less than or equal to 9 in Barry's portfolio. And my portfolio, it's looking at sentiment that is 4 or below. So, different criteria. You're starting to catch the move, on the beginning part with Barry's. You're catching it later with mine. But here's what's happening with Barry's. Companies are starting to pop up in there. So in other words, a lot of companies hitting 10, very strong demand, but we're starting to see some companies starting to fade there. Obviously, there's not very much down below 4 at this particular time. I did mention in today's note, and we'll kind of go into, a look at possibly, what's ahead here. Let me share this. This is an imprecise science. It's a blunt instrument, and I don't know right now if it has predictive value or not. So when I don't know that, I'll make sure to tell you that. But look at what's happening, and what you're looking at here is the weightings for the S&P 500, and look at the weightings declining for tech here over the course of the last month. So it's gone down quite a lot. Now, does that mean that tech could possibly be a buy going into month end? I don't know. That's why I put it in green. It's just something that I want to watch. Like I said, this is a very imprecise science right now, but I'm just trying to build some data over time and see if there's any predictive quality to that. But the point is, tomorrow is month-end activity, and we'll have passive investors especially that are making updates to their portfolios. Are they overweight certain companies? Are they overweight certain sectors? Are they underweight certain companies or sectors? You'll have all of that going on, especially towards the close tomorrow afternoon. Once we move past tomorrow, and Tim kind of mentioned part of this already, I'll kind of start the look at the what's ahead, and then Tim can chime in. I'm a little concerned when we move past tomorrow's trading. Part of the reason for that is this is broad market sentiment right now, and it's getting what I call very, very stretched. Whenever it moves that far above 7, it just gets very difficult for the market to continue to post gains. Go back during the last year, look at any stretch that you want to, market moves sideways, markets moving lower, markets moving sideways, markets moving lower. You get the point. And especially you combine that with the fact that short volumes are moving higher. They're about 100 basis points above 200-day norms right now. So that's pretty significant. They haven't relented yet at the beginning of the year. If you recall, early January, part of our discussion point was, hey, let's watch short volumes, see if we get some relief. Well, they started to trade sideways, just for a little while. We had the inauguration, we got a bump higher. But as you can see, they're starting to move higher, once again. So I could see some upside tomorrow, possibly, just with end of month activity. But it does concern me that the whole market's getting stretched right now, and the fact that short volumes are high. So with that, I'll stop my share screen.
And let's see. So Candace, I might as well just talk to you. So you said if you wouldn't hold over the weekend when demand is above the red line, are you still buying at market close during the week and holding overnight? Yes, but I'm very careful about long positions when demand is over the red line. And look, it's just a measure, but it's been very predictive. Brian and I do this all the time. We'll go calculate what the market returns are over a given period of time, and at various points along that continuum, and above 6, there are no returns. It doesn't mean there aren't any. It's just that if you calculated them over a statistical sample of time, there are no returns. So then why would one try to generate them? Right? So, and at above 6.5, the market has a propensity to decline 5%. Hasn't done that, but it might, right? So if it hasn't done that, and that is what happens historically, past performance is no guarantee of future outcomes, but it could, right? Apple, I will show Apple. Yeah, let me get to that. And let's see. Are these weights in the Excel spreadsheet calculated using the sector market structure sentiment scores for the week? You're talking about Brian's spreadsheet.
Yeah,
right?
and I just answered that, Tim.
Okay,
yeah.
okay.
That comes from SPY Holdings, those weightings.
Okay. Let's see. I will share, and we're mindful of time here. The Apple. That's what I was going to do, and I want to show you this thing on my screen. I can barely do 80% of one thing at a time, let alone two. At least I'm aware of it. So Apple, let's look at Apple. And here's a great example of looking back over time. And I want to show you ServiceNow too. I thought that was kind of interesting. They reported today. And they should stop doing it that way. If we were advising them, if they were a corporate customer, we'd say, stop putting out machine readable data in your earnings release. Just say, we reported results. You'll find them here. Thank you. Goodbye. That's all you need to do as a public company. And it would greatly reduce the arbitrage that creates volatility. Of course, many of us like to trade volatility. So Apple, I would certainly back this up. I like the default day view, but you certainly want to, as Brian said, take a longer look at this and see what's happened over time. Look at what has happened. Apple is a large cap blend, meaning it will spend a lot of time at 5. It's a core portfolio holding. Every now and then it hits 10. Could you have known, if it doesn't very often hit 10, you probably want to take your gains when it does. As soon as the demand starts to deteriorate, take your gains. And you say, well, I missed out on this. Yeah, you'd also miss out on all that, right? It's far better to take your gains. Right now, demand's rising. There was a little divot on the supply side, but that's not great. Would I chase that? Absolutely not. That doesn't mean it's not going to go up, but it's a very simple decision to look at that and say, I'm not buying Apple, right? It is, the whole pattern has changed. And look, Apple's core, this is part of the problem. We're talking about 36% of the market that doesn't look awesome to me, and again, I don't know what's going to happen, but I do know demand's at 7.2. Now, really quickly here, here's something to know about trading earnings. Could you have known that it would get clocked 12%? No, but that's a very big short bet set with the new series of options. So you look at that and say, well, the demand's rising. Yeah, but I would never, ever, ever get in front of that train. Don't want to do that. It's easy thing to avoid. Okay, looking ahead, that's it. It's 7.2, supply rising, options expire tomorrow, month end. Those are used by index funds and exchange traded funds principally to true up portfolios, which is why Brian said, well, they might be light on tech. That assumes that they're reweighting to 32%. What if they're not? Mm-hmm. Right?
Correct.
We don't know what the weightings are going to be. Vanguard has been steadily cutting its weightings. It is the largest holder of U.S. equities. It's actually ahead of BlackRock if you look at 13F filings. And so if it's reducing its allocations to equities, it will weigh on the market. So look, I'm not, as I said, I will share what I do. I have a big short because I think the market could do what it did it's done it twice. December 18, wham. January 27, wham. Could it happen again? Yeah, absolutely it could, because that's baked into the data set now. So just beware, and keep your time frames short, particularly when demand is over the red line. That's all I've got.
Hey, Tim, if we have a chance, there was one last question from Chris. in the January 28th note, you referenced SPY volatility at 825%, and he's
Yeah.
wondering how that volatility is calculated.
Okay, and that reminds me, I wanted to show you this too. So this is not something we post at Edge. We might at some point. This is the S&P 500. It's an internal report of ours called S&P 500 Insights, and I want to show you something there. So that calculation was looking at the volatility of SPY and the day-over-day change. So, to have a change like that, it was purely the rate of change. It was like 17 basis points to 350 basis points. Never happened before. Never even happened during that whole period in March of 2020. The biggest move was about 400%. So, is that material? What's in the data set? That's the problem. It gets baked into all the data sets that everybody uses, and you don't know where it's going to show up, and then wham, it does. Right? So that's why I look at those things. And they don't happen very often. That last happened in 2022. Right? So yeah, I just am aware of those things. And then this view, the last thing here, all this is showing us is how the prices of there are 504 at the moment components of the S&P 500 because it gets changed periodically. And so we calibrate the prices of all of those and how they're performing relative to midpoint. So notice January 27, terrible day in the markets, but in the data versus midpoint, it wasn't. Now, if it's green, it means things are closing above the midpoint, and then by what degree? And so, and then when it's red, they're closing below the midpoint, and by what degree? Look what's happened. It's starting to deteriorate. It recovered, had a great right into options expirations in January. These are patterns of up, down, up, down, up, down. That's what ETFs do because it's arbitrage. Long short the basket in the ETF, and it's deteriorating. And then we look down and say, well, what's doing it? ETFs. Okay, are they selling stuff? Well, they might be. But we don't even need to know all that. We already know this. This is the best thing of all. We know at this level, there is a probability that the market declines. And then you say, but it already has. Maybe it's over. Might be. But I just look at that balance and say, boy, that is, could be bad, but might not be. But it could be. So that's how we think about those things. Okay, it is 1:09, so we have to run. Thanks. We didn't quite accomplish our objective, but we'll take the small victory. Good to see everybody. It will be past Groundhog Day when we see you again. So we'll look forward to that. Thank you. Have a good weekend, everybody.